Welcome back. The market yesterday was down quite a bit, but most of it looked like an expiry play when the Nifty fell 200 points from the highs in the last hour and the Bank Nifty fell 500 points. This morning, given the positive global cues, especially the way the Dow surged in the end, the SGX Nifty is up about 100 points. Keep in mind, we're starting a new series, so there's a massive premium as well in Nifty futures. So you'll have to adjust for that. It's not the spot opening that will be at 17,683, even if SGX Nifty is right. Gurmeet Chadha is joining us, Managing Partner and Chief Investment Officer at Complete Circle Consultants. Gurmeet, hi, good morning. Thanks a lot for joining us. Gurmeet, I wanted your views on what's happening in the Tier 2 banks. I mean, RBL, of course, has been on fire for the last 3 days, 30% move, I think more than that. But there are others as well doing well, Bandhan, City Union, AU. Any views here?
Good morning, Anil. I know if you recollect, we did discuss how the focus can now shift as the bank balance sheets are looking better, and I think the pre-COVID stress looks behind. I think within that pack, we still continue to like IDFC first. We discussed last time. I think what's impressed me is that last 3 years the texture of the loan book has changed. It's become more granular. The infra assets are now around 5% of the book, which is the legacy book, which was the key concern of the market. Also, if you see the retail book is now almost 70% with good CASA and NIMs. And Anuj, you'll probably see a liability war over next 1 or 2 years with the HDFC and HDFC Bank merger happening. So it will be a very interesting. It's a very interesting setup. So I would still prefer the larger banks and some banks where probably you are at one book value, something like an IDFC to play this.
Gurmeet, hi, good morning. I wanted your thoughts on how to approach a stock like Eicher Motors, sitting at a fresh high, but now there's a resignation of the CFO that has come in. There's a new CFO that will be intimated very soon. But, I mean, at a time like this, what do? The business is growing well. Management changes, I guess, are par for the course, right? So not to worry too much?
See, there will be some short-term reaction to any management exit, and Eicher has probably had a little more to its share in the last few years. So if you see, Sonia, from FY19 to 22, the volumes have around shrunk by about 32%, which is in line with the industry. The average price of the vehicle for various reasons has gone up by 22-23%. So now there is a slightly differentiated strategy. Obviously, they've made up something through exports, which is up almost 3-4x. So now they are shipping like 10-12,000 units. So India, I think what they're trying to do is focus on this 125-150cc segment where the average price is 1.5 to 2 lakhs. Try, they have that 1 lakh unit capacity a month. Try get the volumes back. Do some good allocations to launches like Hunter, which are still aggressively priced, but give them better ROEs. And export is where they are more in the mid-weight segment, right, which is 350 to 600cc. Also, the Volvo, the CV upcycle, I think they should benefit. I think they have slightly technically superior offerings there. But it's the price. I think it's almost priced to, I won't say perfection, but at 3,500, if you pay 27, 28 times to FY24 earnings, then you got to be growing what they have been doing, when Eicher used to do well. So you have to see how the growth pans out. I think from at current price point, probably TVS, I think, with the way it has done in last 4 quarters, record, despite all headwinds, double-digit margins. I think there's also great progress on iQube, which is their, the EV offering within the two-wheelers. So between the two, probably will prefer
that. Got that. Gurmeet, the kind of moves we've been seeing where a lot of beaten down kind of names are coming back, right? Some are pointing to some of what is going on and saying, well, this is a bit of a low quality move we are seeing. Would you pay too much attention to that? Or you'd say, well, that's par for the course?
Happens in every market, Prashant. Even in growth phase, we had obnoxious multiples, like new terms being invented, price to sales, etc. But broadly, I think what the market is that and you made that point that whenever the 10-year bond in US would be above 3, oil will be $100 plus, dollar index being where they are, and you are now in a tightening interest rate environment, you got to pay more reasonable valuations, and that is what is probably is playing out across sectors. Even in consumption space, you probably see ITC doing better than some of the high growth and marquee names. Same is the case with in the banking space. Suddenly 4 or 5 book multiple banks have been struggling, right, versus the banks which are showing improvement. So happens, I think. I think it's what portfolio probably needs is a blend of both growth and value. And I think the only hedge in this environment, and I keep saying this, is earnings growth. It's going to be a tough environment. I don't think so. We are out of the woods. So if you pay for earnings and if you pay a reasonable price, I think there's still some money to be made.
Okay, well, another stock I know that you track closely is Minda Industries, which is now called Uno Minda. So we have the management with us. Gurmeet, just request you to listen into the conversation and then give us your thoughts. Uno Minda is looking to invest around 300 crores to expand its manufacturing capacity of four-wheeler alloy wheels and four-wheeler automotive switches in order to meet the rising demand. We all know that there is a slew of new launches, especially in the electric vehicle space, and a lot of these auto ancillary companies are gearing up to service these OEMs. So Sunil Bora, the Group Chief Financial Officer at Uno Minda, joins us now to talk about that. Sunil, good morning and thanks for joining in. Tell us a little about this expansion plan. When will it come on stream and when will it start to, show up in your revenues?
Yeah, thank you, Sonia. So board has approved 300 crore worth of expansion yesterday. It's primarily into two businesses, as you rightly mentioned. The first one being in the four-wheeler alloy wheels. And as you know that this is actually the third expansion in last 12 to 18 months, which we are going ahead with. Because the application ratio of the alloy wheels to steel wheel has continuously been increasing. And we believe that still there is a huge potential for further growth. Just to give some background, when we entered this business 6 odd years back, the application ratio was in low teens, which today is in mid 30s. And if we compare with some developed economies, it's very high. It's maybe in 80-90% kind of a zone. So there is definitely going to be a significant demand potential even in future, where the application ratio improves. Even from customer perspective, people are preferring alloy wheel cars, or maybe people are trying to get the alloy wheels retrofitted when they buy the car from the showroom or in the aftermarket. So there is a huge potential for four-wheeler alloy wheel business. And in fact, that's the business which we have been running more than capacity. And there has been continuous increase in demand. So this expansion will increase supplies by maybe middle of next calendar year. And with this, our alloy wheel capacity for four-wheeler will be something around 3.5 million wheels per year. Moving to the four-wheeler switches, that segment also has been doing pretty well, and we have been getting some traction from export as well. So our existing facility in Manesar, we have been facing space constraints. So we will be moving some part of that business to create some space to a new location in phase 1. And gradually in phase 2, at the later stage at appropriate time, we might expand that facility for which the land is acquired, which will be sufficient to meet the next phase of growth as well. So that also plant we are expecting to commission by middle of next calendar year.
Okay, Mr. Bora, good morning. Just a couple of questions. The investment that has been approved, it is part of the overall capex guidance for the year, right? 600 crores.
No, so this is definitely beyond that.
Okay.
So the guidance which we gave at the beginning of the year, we had already few projects running, and also the sustaining capex which has taken a pause in past couple of years because of the pandemic, that also is being gradually kicking in. The 600 crore definitely was excluding this capex which has just been approved yesterday.
Okay, so now is there a new guidance? I mean, including this, will there be more?
Difficult to say at this stage, because I think our stated guidance has been that we continue to grow more than industry growth at least 1.5x of the industry growth. And to meet this continuous growth, definitely we need to deploy or reinvest in the business. Obviously, our endeavor is to redeploy in the business where we can actually create shareholder value and get better returns. So at this point in time, I think our overall guidance will be 600 crore plus maybe part of this 300 crore which has been announced yesterday.
Okay, all right. So, your kit value has increased recently because of the orders that you're getting from the facelift models that have been launched by OEMs, right? What does this mean for your margins? Because in the quarter gone by, your margins have improved. Now you're sitting at 10.4% margin, so it's double digits. Can you do better by the end of the year because of the rise that we've seen in the kit value?
No, definitely, Sonia. We do expect our margins to improve in the coming quarters. And at the beginning of the year, we did give a guidance for the full year EBITDA margin range of 11 to 12%. So with 10.4 in Q1, definitely we need to better on that so that we get average of 11 to 12, and we are committed still on to maintain that EBITDA margin guidance for the full year.
You know, the switching segment is your largest segment, some 30% of sales. But in Q1, that was absolutely flat. that segment did not do very much for overall growth. You're adding capacity there. Can you just talk us through the logic? I mean, you said you're constrained as is, right?
Yeah. So the kind of new businesses which we have been generating, obviously, the business which you get today, normally it gets fructified in 2 years or 3 years time, depending on the model launch of our customers, right? So today might be that capacity is sufficient for today's revenue, but if I have to increase my kit value, which I have got either share of business increase or increase in kit value, I have to obviously support that business going forward. So we have to invest in capacity and expand. So that today the business which might be constrained because of space, we need to create infrastructure not only for meeting the businesses which we have already secured, but also to make sure that we have a ready platform for future growth from there on. So that is why we are actually getting into a new location, and which will have enough space for catering to next leg of growth from this region, maybe for another 4 to 5 years.
Okay, and you're also winning a lot of orders in the electric vehicle OEM space. So in Q1, you bagged orders to the tune of 470 crores. When will you execute these orders? When will it flow through in your revenues? Will it be in FY23 itself? And any more order visibility on the EV side?
So, Sonia, as I said, most of these business which we secure, normally there is a cycle. So if you secure a business, then it gets into development cycle, proto, testing, etc., etc. So it will be minimum 12 to 18 months before you actually see the revenue flowing to your balance sheet or P&L account. So most probably all these businesses which we have secured this year will be trickling in gradually from the next financial year into the P&L.
And so far in Q2, I mean, on EV side, would it be possible to disclose the quantum of orders won?
So normally we do communicate whatever we have business we have secured on a quarter-to-quarter basis. So we have just completed our board meeting in the earlier part of this month on 8th and 9th only. We have sort of communicated the new business which we have secured. So it's too short a time to give you any update. So maybe the next call we can give you a little better update.
You know, just a quick bit. International business is about just under 20% of your overall sales. Is any of this macro slowdown talk having any impact whatsoever? Do you see it having any impact on your business?
Well, definitely it does. There is an impact in our European business, both Spain and Germany, if you see in terms of volume. But what is happening there, we have been adding more products. And because of more products and increased kit value, we have been able to maintain our absolute revenue, or even actually in Q1, we have done highest ever revenue in our European entities. And if you talk of ASEAN, we are actually doing pretty well. In fact, just in the previous call, we also announced setting up of a new lighting plant in Vietnam. Currently, we have only switching plant. Now we'll be setting up another lighting plant in Vietnam. So all this, I think, if you see from the strategy perspective, what we have adopted a year and a half before, which is setting up our dedicated marketing offices in ASEAN and Europe, they are actually now reaping us fruits by getting more businesses. And that is what you are seeing in terms of additional capacity and the new plants which we are setting up in these regions.
By the end of the FY23, what kind of growth are we looking at on the revenues? In Q1, you had a 60% growth, of course, on the back of a lower base. But by the end of the year, what's the growth target?
It's very difficult. We know that we have dependency on 90% of our revenues from our OEMs, and those volumes are not in our hands. What is in our hands is to see that how do we consistently increase our kit value and share of business. And as you have seen in past few years, we are committed that we should be able to get at least 1.5x growth of what industry grows. So our goal is to outperform the industry growth, and we are pretty confident we should be able to do in this year as well.
Okay, all right. We'll leave it at that. Thanks a lot for joining us, Sunil, and have a great one. That's Uno Minda. Gurmeet Chadha tracks this very closely. Gurmeet, this is a business that will only grow from here. It's been a compounder in the past, and now they're investing a lot of money because there's so much demand. But how does the risk reward look now in favor of a long-term investor?
So, Sonia, very biased since being an owner in this counter for 4 or 5 years now, was sub $1 billion valuation. And if you see last 4 years, which have not been very great for auto, I think the stock has almost gone up 3-4 times. And so what is done as well is that, so 3 things it has captured. Well, one is premiumization, which right now, the management was talking about. So from horns, switches, which they are leader, They got into alloy wheels, where they market. They're number one in horn switches, alloy wheels, etc. They are number two in airbags, air filters, speaker systems, and now they are getting significant presence in sensors and reverse parking sensors. And now there is an EV portfolio also, which is ready. So there is premiumization, there is EV, and there is a little bit of import substitution and benefit of the PLI scheme. Return ratios have been very, very good. My sense is that this is one company which gives you the play on both ICE, which is your traditional play, as well as the EV portfolio, which they are getting ready with smart plugs, on and off board chargers, and battery management system. So I think the kit value is continuously going to go up. And this is one counter which I think which can still grow their revenues at 20-25% with improving operating metrics as they were talking about. So remain very constructive on it for the long term.
Okay, remain constructive on it for the long term. That's Uno Minda. The stock, of course, has done really well. Now, Gurmeet, I wanted your views on some of these names like NTPC, Coal India, and some of these silent movers. Any view on these? I mean, they've done remarkably well this year.
Yeah, I mean, Anuj, as I said, we were discussing that value play coming, and obviously there were factors which were supporting earnings also in terms of the power shortage and especially the coal shortage. One play we do like in this space, which not really linked to it, is startup power. I think it's the way it has transformed in last 4 or 5 years from a traditional thermal power, generator, distributor, and transmission, to now a new age power company with company has a clear guideline of having a 25 gigawatt clean energy portfolio. We saw investments in the renewable subsidiary with BlackRock and others coming in. They're also getting future ready with EV charging, where they're almost 40% in terms of market share. The solar EPC is where they're again very dominant with more than 10% market share, 12,000 crore of order books. So it's playing that energy mix change pretty well, more for the long run. The plays like Coal India, NTPC can be good dividend yielding stocks because valuations are very, very reasonable. NTPC in particular, if you can see more value unlocking the way others have done in the private space, at 150, 160 levels looks attractive, but PSUs always have that overhang of policy intervention and pricing controls. So you can't really take a long-term view there.
Okay, stay on. We have many more questions for you, but we need to take a quick break. On the other side of the break, Shrikant Chauhan and Kush Bora will join